This is Philip Strebo with the RJOF Futures in Chicago. In this quick video, we are going to be discussing how to buy a futures contract. We'll also be discussing some of the risks involved in buying futures contracts, as well as some of the reasons why people trade futures in the first place. RJO is a full-service futures trading firm that has been around over 100 years, and have been advising clients as well as assisting those who would like to become involved in futures trading. Now remember that in futures and options trading, there are substantial risk of loss, and it may not be suitable for all investors. So one of the most common questions that people ask me with regards to futures trading is, why do people trade futures in the first place? And it's a pretty basic reason. It has to do with leverage. Leverage is the ability to control a large dollar amount of a commodity with a comparatively small amount of capital. Now, to give you an idea on how leverage works in futures trading, I'm going to give you a quick example. And in this example, we're going to look at the gold futures contract. We are looking at gold because it is one of the most actively traded markets in commodities. So let's assume we expect the price of gold to move higher from where it currently is. So we are bullish on gold. Therefore, one of the most basic things we could do is buy a futures contract to gain bullish exposure. Now, when we buy one futures contract, it's not really like buying one share of stock. One futures contract includes 100 ounces of gold. Now let's assume the current price of gold is $1,200 per ounce. Therefore, the full contract value of the futures is $120,000. Now, we're not expected to put up $120,000. Instead, we are going to be required to put up a deposit. This deposit is approximately $6,000 for gold and is what we refer to as margin. Now let's assume we bought the futures contract with gold trading at $1,200 per ounce, and over the course of time we hold gold and it rallies on up from $1,200 to $1,300 per ounce. We would then have a $100 profit per ounce times 100 ounces of gold in the futures contract for a total of $10,000 profit, and this is where the leverage is. Now let's look at this here from a trading perspective. This is a 60-minute chart of gold, and as you can see, gold has been rising out of a sideways channel as the evidence from the trend line you see. But more importantly, we want to look at the resistance areas near $1,191 per ounce. Anything over $1,191 based upon previous resistance would constitute as a breakout on this 60-minute chart. Now these areas, they've been tested and they've failed several times. But now that we've seen gold break out above the resistance, we may want to look to play this type of trade setup here. So what we would do is look at buying the breakout above $1,191. So when you place those orders, you would put in a buy stop at $1,191, and you would put in a sell stop down at $1,180. That's to define your risk parameters. This is the last corrective low of the channel. It would probably serve as a good risk parameter as a sell stop. Therefore, we would be in and out of this trade at or around this area. We'd have a defined loss of $11, and that's $11 times $100 per ounce, resulting in a $1,100 loss. This is an example of how the leverage would work against us. So remember, in buying a futures contract, here are a few tips to know. A trade will realize an immediate profit with a move higher than the price we bought. The trade will realize an immediate loss with a move lower than the price we bought. The margin deposit is required for each contract bought or sold. So that's one $6,000 margin deposit for each gold contract that has been bought or sold. Now remember, buying a futures contract, there are a few quick tips you want to know. Understanding the leverage and contract specifications for each commodity that you become involved in. Also understanding the margin requirements for each commodity that you become involved in. Remember, the contract specifications and the margin requirements could greatly differ from one contract to the next. So the margin requirement for gold could be substantially higher or lower than that of corn or soybeans. And remember, you always want to use a stop-loss order to try and protect yourself. Now remember to take your time in learning what you need to know and to do your due diligence before investing. There is also a great deal of knowledge and resources on RJOFutures.com, so be sure to check us out there.